How to draw a trend line. What is a trend line?
A trend line is a graphical representation in a chart or graph that shows the general direction and momentum of a data series. Typically, trend lines in technical analysis are used for financial markets or other forms of data analysis.
Use of trend line.
Trend lines are used to identify and illustrate the prevailing trend or pattern in the data, making it easier to make predictions or decisions based on historical price movements or other variables.
How to draw trend lines.
In a price chart for a financial instrument, such as a stock, currency pair, or commodity, a trend line is drawn by connecting two or more significant points, such as lows or highs, on the chart.
There are two primary types of trend lines.
1. Uptrend line or support trend line, a line drawn below the price data connecting a series of higher lows.
It represents an upward or bullish trend in which the asset's price is generally rising.
2. Downtrend line or resistance trend line, a line drawn above the price data connecting a series of lower highs.
It represents a downward or bearish trend in which the asset's price is generally falling.
Trend lines help traders and analysts identify support and resistance levels, as well as potential entry and exit points for trades. They provide a visual guide to the direction and strength of the market trend and are a fundamental tool for technical analysis.
Draw trend lines. How to draw a trend line in chart.
A trend line takes shape when you can connect at least two or more price swing points or pivot points with a diagonal line. It's often referred to as a sloping line, and it's created on a chart by linking two or more data points.
Generally, trend lines drawing will have 3 points. They are: starting point. This is the initial point from which the line originates and serves as the starting point.
When it comes to creating trend lines, it's essential to understand that you require a minimum of 2 market points to initiate a trend line.
Validation point.
This is the second point, or point 2, which validates the straight line when connected to point 1. After identifying the second swing high or low, you can establish a connecting trend line.
Confirmation point.
The third point is of significant importance as it provides validation to the trend line. While it's possible to establish a trend line with just 2 points, the third point serves to confirm its validity. It's essential to remember that any pair of reference points can create a trend line, but it's the presence of the third touch point that solidifies the slope's reliability. Therefore, before placing substantial reliance on a specific gradient, it's advisable to seek that third touch point for increased confidence.
Draw trend line in chart.
The diagram above illustrates a support trend line and how point 3 has confirmed the trend line drawn from points 1 and 2.
It also demonstrates how point 4 found support at the trend line.
Interestingly, point 4 presented a favorable buying opportunity, highlighting how trend lines offer support, and prices tend to rebound upon reaching them.
Draw trend line in chart.
As previously mentioned, a resistance trend line can be drawn in a similar manner. However, it's worth noting that prices often encounter resistance at points 3 and 4 and subsequently trend lower.
In the provided chart, a blue trend line is drawn by connecting point 1 and point 2.
Notably, points 3 and 4 have encountered resistance at this blue trend line, presenting a selling opportunity.
Key considerations for trend lines. Here are some essential considerations when studying trend lines.
1. Bullish and bearish trends. A trend line above the price action signifies a bullish trend, while a downward sloping line acts as resistance, indicating a bearish trend.
2. Higher time frame dominance.
The trend of a higher time frame takes precedence over that of a lower time frame. Trendline trading strategy of trading in the direction of the higher time frame trend is often more profitable. 3. Maximizing touch points. When drawing trend lines, aim to capture as many touch points as possible without intersecting candle bodies, even if there's some overlap from the candle's high or low. For line chart effectiveness, trend lines drawn using closing prices on a long-term chart are particularly effective. They are useful for trendline analysis on breakout and can be applied to various chart types.
5. Acceleration after a break. When a trend line is broken as either support or resistance, the subsequent price movement should exhibit acceleration in the direction of the breakout. A lack of such acceleration can indicate a potential false breakout. 6. Flipping dynamics. Once a trend line is breached, the role of support becomes resistance, and resistance turns into support in the price action. How to draw trend line in candlestick chart. Locate the trend lines. Demonstration. In an uptrend, the trend line is drawn beneath the price. The trend line includes the highs during a downtrend and the lows during an uptrend. Candlestick chart. The chart above is an illustration that depicts how to draw a trend line using the bodies of the candles. To create a trend line, you need at least 2 swing highs or swing lows. The credibility of a trend line is established when a minimum of 3 highs or lows are employed. The higher the number of times the price interacts with a trend line, the stronger its validity, as it garners more attention as a support or resistance level. When sketching a trend line, many traders opt for wicks, while some favor the candlestick bodies, both of which are acceptable methods.
Summary. A summary of the lesson covered thus far. Trend lines, drawn either above or below the price, serve as indicators of the prevailing trend and the points at which a trend shift may occur. Additionally, they function as valuable support and resistance levels, facilitating position entry and exit.
In an uptrend, trend lines are positioned below the price, whereas in a downtrend, they are located above it.
For an uptrend, a straight line links 2 lows, while in a downtrend, it connects 2 highs. To validate a trend line, it must connect with a minimum of 3 highs or lows. The degree of validation of a trend line increases as the price interacts with it more frequently. A trading technique involves monitoring a trend line break, wherein the price breaches the trend line.
Frequently asked questions. How to draw trend lines correctly.
1. Identify at least 2 significant swing highs or lows in the price chart.
2. Draw a straight line connecting these points for an uptrend or downtrend.
3. To increase validity, aim for a minimum of 3 touches along the trend line, and consider using wicks or candlestick bodies when drawing.
How to draw trend lines in Forex. To draw trend lines in Forex.
1. Identify at least 2 prominent swing highs or lows on the Forex price chart.
2. Connect these points with a straight line for either an uptrend or a downtrend.
3. Seek confirmation by looking for at least 3 touches along the trend line, and consider drawing the trend line through wicks or candlestick bodies for accuracy.
How to draw trend lines on stock charts.
1. Locate 2 or more significant swing highs or lows on the stock chart. 2. Draw a straight line connecting these points, positioning it below the price for an uptrend and above for a downtrend.
3. Verify the trend line's validity with at least 3 touches along it, whether as support or resistance. How to draw trend lines for intraday.
1. Identify key intraday swing highs and lows on your chart.
2. Connect these points with a straight line, keeping it below the price for uptrends and above for downtrends. 3. Ensure trendline validation by observing at least 3 price touches for support or resistance during the intraday trading session. When do we always draw trend lines above the candles?
1. Draw trend lines above the candles when identifying a downtrend.
How do we trade using a trend line? Introduction.
Trend lines are diagonal lines drawn either above or below the price, serving as valuable indicators of the current trend direction and signaling shifts in trends. Additionally, they function as support and resistance levels, offering opportunities for entering and exiting positions. Trading with trend lines can be approached in 2 primary ways. Using trend lines as support or resistance. One common strategy is to consider trend lines as potential points of support or resistance in the market. For instance, if the price finds resistance at a trendline pattern, it can signal a trading opportunity.
Traders often set their stop-loss levels just above the identified trend line.
This approach is clearly demonstrated in the chart example, where the trend line serves as a resistance level and traders use it for entry.
Support or resistance. Trendline breakout strategy.
The trendline breakout strategy involves recognizing when the price breaks through a trend line, indicating a potential change in the trend.
Traders can choose between 2 entry methods, the aggressive and the conservative approach. Aggressive entry.
In this method, traders act swiftly as soon as the candlestick breaks through and closes on the opposite side of the trendline pattern.
Aggressive entry. For example, if there's a trendline breakout, a breakout trend, to the downside, traders may consider a short entry.
To manage risk, a stop loss is typically placed just above the trendline. The chart example above illustrates an aggressive entry following the candlestick's closure on the opposite side of the trendline.
Conservative entry. A safer way to trade after a trendline break is to wait. First, let the price break the trendline. Then, see if it touches the trendline from the other side, like a wall or a floor. If it does, you can consider making your move. Conservative entry. The price goes down past the trendline. Wait for the price to return to the trendline and face resistance. When you're sure the breakout is real, make a short trade. Put a stop loss above the trendline for safety. The chart above illustrates a situation where a trendline, initially supporting the price, is broken. Later, the price checks it from the opposite side, acting as resistance. This strengthens the belief that the breakout will probably persist. Once the trendline has been confirmed as resistance, you can consider taking a short position and put a stop loss on the opposite side of the trendline for safety. Be cautious with trendline breaks. Be careful when dealing with trendline breaks. It's wise to wait until a candlestick has either closed on the opposite side of the trendline or tested for support or resistance. If there's no closure on the other side, it's usually not regarded as a genuine break. Trendline breaks. False breakout. In the chart above, the price initially dropped below the trendline. However, it later rebounded, and the candlestick ended up closing above the trendline. If a trader had entered a trade immediately when the price initially broke through, it would have resulted in a losing trade. Key takeaways. In summary, trend lines are invaluable tools for trading. They help spot trends and guide trading choices. Draw below for uptrends and above for downtrends. Verify with at least 3 highs or lows. More touches make it stronger. Use them as support or resistance for trades. Trendline breakouts offer trading opportunities. Consider automated systems for better trendline trading strategies. Frequently asked questions. What is a trendline trading strategy? A trendline trading strategy is a method using trend lines to identify trends and decide when to buy or sell assets. What are the types of trend lines in technical analysis? Types of trend lines include uptrend lines, below price for upward trends, downtrend lines, above price for downward trends, horizontal support lines, at support levels, and horizontal resistance lines, at resistance levels. What is a trendline breakout strategy? A trendline breakout strategy is about trading when the price breaks a trendline, signaling a potential trend change. What is a trading line? A trading line is another term for a trend line, a diagonal line used to identify trend directions. How do I trade a trend line breakout? To trade a trend line breakout, identify the trend line, wait for a breakout, confirm it with a close or test, and then enter the trade with a stop loss. How can I use the trendline breakout strategy effectively? Use different time frames for confirmation, combine with indicators, manage risk with stop-loss orders, stay patient for strong confirmation, and practice on historical data to refine your approach. 2. Locate 2 or more significant swing highs in the price chart. 3. Connect these points with a straight line, placing it above the price to delineate the trend's resistance. How do we trade with Fibonacci levels? Using Fibonacci levels in trading is like having a special tool. It helps traders figure out how prices might change. Traders use this tool to draw lines on a price chart. These lines are called Fibonacci levels. They work just like regular support and resistance lines, guiding traders on when to buy or sell. Setup of Fibonacci retracement levels in MetaTrader 4, or AMI broker chart. Fibonacci levels help identify support and resistance on your price chart. The Fibonacci tool is used to measure a price move. When the price goes up or down, you can easily see where it started and ended. With the Fibonacci tool, you calculate this distance, and it automatically shows Fibonacci retracement and extension levels on the chart. These levels act like support and resistance points. The calculations are based on the Fibonacci sequence, but in this lesson, we'll focus on how to use the tool, not the math behind it. Linking moves A to be using the Fibonacci retracement tool. Fibonacci levels. Fibonacci retracement tool. When analyzing a downtrend, the Fibonacci tool is used manually. In a downtrend, you apply the tool from the beginning of the downward move to the end, always from left to right. The following chart demonstrates how this process is carried out. The chart below shows 38.2%, 50%, and 61.8%. These levels are commonly used even when other retracement levels have been identified and are effective in trading. Downtrend.
1. The tool begins at the top when it is drawn.
2. It concludes at the bottom, drawn from left to right. When analyzing an uptrend, when there's an upward move, the tool is used from the bottom, ending at the top, always applied from left to right.
This method comes to life in the visual representation provided in the chart below.
Uptrend. A. The tool is started from the bottom. B. It is ended at the top, drawn from left to right. In MT4, Fibonacci levels are automatically generated.
Once the Fibonacci tool is applied, it positions these levels between the starting and ending points of a move, visible in the charts above. These points are referred to as retracement levels.
These Fibonacci levels are represented as percentages of the total move.
For instance, the level placed exactly halfway between the start and the end of the move is the 50% retracement level. If the price retraces halfway back, it's considered to have retraced to the 50% level. This level then functions as either support or resistance, depending on the direction of the trend.
In essence, these retracement levels indicate the extent to which a pullback might occur.
In the chart below, you'll find the 38.2%, 50%, and 61.8% levels.
These are frequently used points to which the price might retreat.
It's worth noting that there are additional retracement levels that have been identified and prove effective as well.
Retracement levels: 38.2% level, 50% level, 61.8% level. Choosing the appropriate entry point. To choose the right level to enter the market, traders have two approaches. Aggressive entry: traders can choose to enter the market as the price reaches each retracement level.
They enter at each level, placing a stop loss on the opposite side of the Fibonacci level. If the stop loss is triggered, they enter again at the next level and continue this process until the price moves in their favor. This method is more aggressive in using the Fibonacci tool for entries. Patient entry: alternatively, traders can wait until the price finds support or resistance at these Fibonacci levels. They observe the price for signs of support or resistance, wait for the price to move back in the original trend direction, and then enter the market.
Fibonacci extension levels.
Fibonacci extension levels serve not only to identify retracement levels for support or resistance but also to project where the price might reach. Traders use Fibonacci extensions for profit taking or even making entries against the current trend. Traders often rely on common extension levels such as 138.2% and 161.8%, although there are various other extensions used by different traders. The example below illustrates extension levels in a downtrend.
Strategy 1. Fibonacci extension levels. 138.2% extension level. 161.8% extension level. Strategy 2. Traders utilize the Fibonacci tool to enter a position at a retracement level when the price pulls back and exit at one of the extension levels when the price moves further. The chart below displays the extension levels of the Fibonacci tool applied to an uptrend, clearly showing both the retracement and extension levels. Fibonacci. Potential long entry at a retracement level. Potential exit at an extension level. How to determine the profit-taking extension level. To maximize profitability, traders can match extension levels with corresponding retracement levels. For instance, if the price retraced to the 38.2% level, the related extension level would be 138.2. Extension levels. Short entry at 38.2% retracement level. Corresponding extension level of 138.2%. Strategy 3, the related extension to the 50.0 or 61.8 retracement level is 161.8. Extension levels. Short entry at 50% retracement level. Corresponding extension level of 161.8%. Fibonacci retracement and extension levels are correlated with each other. The self-fulfilling prophecy concept is relevant in this context. Banks and large financial institutions often aim to take their profits, targeting specific Fibonacci extension levels. They anticipate that other banks and traders will do the same,
creating a self-fulfilling prophecy where these levels become significant points of action.
However, it's crucial to understand that this isn't a strict rule.
For extension levels to be effective, they must align with a confirmed trend, which doesn't happen every time. A simpler approach to using extension levels is to exit a trade when the price encounters significant support or resistance at these Fibonacci levels. If the price struggles to break through a Fibonacci level, it can be considered a good exit point.
Nutshell.
The Fibonacci tool places support and resistance lines on a chart based on price movement. Always apply from left to right for both uptrends and downtrends. Retracement levels are between the start and end of a move, indicating possible price reversals. Common retracement levels 38.2%, 50%, and 61.8%, used for market entries. There are two entry methods: aggressive, entering at each level, and passive, waiting for price reversal. Extension levels show where prices could go beyond the initial move. Common extension levels 138.2% and 161.8%, used for market exits. Retracement and extension levels can match. For example, retracement to 38.2% often extends to 138.2%, and retracement to 50% or 61.8% may extend to 161.8%.
Frequently asked questions. What is the fundamental principle behind the Fibonacci trading strategy?
Fibonacci's trading strategy relies on specific price levels derived from the Fibonacci sequence, guiding traders on potential entry and exit points in the market.
How can one determine Fibonacci levels for Nifty trading today?
Traders can calculate Fibonacci levels for Nifty based on the most recent price movements, aiding in making informed trading decisions for the day.
What's the significance of Fibonacci retracement in Bank Nifty trading?
Fibonacci retracement in Bank Nifty trading helps identify potential reversal points, allowing traders to anticipate market movements for better strategy planning.
How does Fibonacci trading benefit beginners in the market?
Fibonacci trading offers beginners a structured approach to understanding market trends, providing clear levels for entries and exits, making trading less complex.
What's the difference between Fibonacci retracement and extension levels?
Fibonacci retracement levels indicate potential reversal points, while extension levels project where prices could move beyond the initial trend, aiding traders in profit-taking strategies.
How can Fibonacci levels be utilized effectively in intraday trading?
In intraday trading, Fibonacci retracement levels can guide traders on entry and exit points within the same trading day, enhancing short-term trading decisions.
Resistance analysis. What is resistance in trading?
Resistance in trading refers to a price level at which a stock or other financial asset struggles to break above, often seen as a ceiling preventing further price increases. Traders often use resistance levels to make decisions about buying or selling, as breaking through resistance can indicate a potential upward trend, while failure to break through can suggest a reversal or continuation of a downward trend.
What is the resistance level?
The significant prices at which buyers have already entered the market in adequate quantity, and they pause to reverse the price movement.
The traders use these price levels to analyze the likely entry of buyers again into the market. Example.
Consider a scenario where you hold a long position in shares of company ABC, presently priced at 100 rupees. The prevailing upward momentum encounters resistance at 110 rupees. Consequently, you've determined to seize profits when the market reaches 110 rupees in the next uptick. As the market indeed ascends, you close your position, prompting many other market participants to also sell their shares, leading to a downturn. This sell-off indicates that the asset has confronted a resistance level at 110 rupees and is poised to retreat once more. Should the market successfully breach this resistance, it would likely experience a rally fueled by heightened market confidence, establishing 110 rupees as the new support level where buyers enter the market.
Analysis of resistance levels.
This can be analyzed on price charts with horizontal lines where there is a pause in price at the same level again and again.
When the price moves higher, it will undoubtedly hit the ceiling. This is the point at which the price pauses and reverses. How to plot resistance level and support level for any given security?
Many traders utilize charting software available on platforms like Enrich Money or in apps like Orca app to pinpoint support and resistance levels. The steps employed in plotting the support and resistance levels are: choose the security for analysis, such as a stock, index, or currency pair. Select the desired time frame for analysis, whether daily, weekly, or monthly. Plot the price data of the security on a chart with the chosen time frame, using charting software or an online platform. Identify areas on the chart where the price has consistently bounced off a specific level, support, or struggled to break through a certain level, resistance. Use horizontal lines on the chart to mark these levels.
Resistance levels.
Verify these levels by examining trading volume and price action around them.
High trading volume and price reversals suggest strong support or resistance.
Utilize the identified support and resistance levels to inform trading decisions, such as buying at a strong support level or selling at a strong resistance level.
Illustration.
Consider the resistance chart below, where it is observed that the price repeatedly pauses in the same place.
The buyers enter the market in this place.
It shows that placing a horizontal line where the price seems to pause assists us in finding a resistance level where sellers are entering the market and stopping the price.
Resistance levels. The above chart demonstrates the utilization of candle bodies to establish the resistance line.
Placing support and resistance does not adhere to a fixed method. Traders need to adopt a suitable plan and strategy for effective implementation.
Support and resistance levels should not be determined with a single line. Establishing a zone is more effective. Practical session.
We need to observe where the price repeatedly pauses in the same place.
The buyers enter the market in this place.
The illustration below shows that placing a horizontal line where the price seems to pause assists us in finding a resistance level where sellers are entering the market and stopping the price.
Practical session. The chart above illustrates using the bodies of the candles for the resistance line. There is no definite method for placing support and resistance.
A suitable plan and strategy have to be adopted by the trader.
Support and resistance levels cannot be settled correctly with a single line. It is better to establish a zone.
Which indicators or strategies incorporate the use of level of support and resistance?
Support and resistance levels find applications in various indicators and strategies within technical analysis. Here are a few examples.
Trendlines. Trendlines are drawn to ascertain the trend direction in a security. Connecting a series of higher lows forms a support level, while connecting lower highs creates a resistance level. Moving averages. Moving averages smooth out price data to identify the overall trend. When the price is above the moving average, it acts as a support level. When below, it acts as a resistance level. Breakout strategies. Breakout strategies aim to capitalize on price movements post a security breaking through a key support or resistance level.
Traders often wait for high trading volume before entering a trade in the breakout direction.
Pivot points. Pivot points consist of horizontal support and resistance levels calculated based on the previous day's price action.
Traders commonly use these levels to pinpoint potential entry and exit points for their trades. How to avoid false breakouts. Long trade. Once the price has broken through a resistance level, wait until the previously established resistance level is shown to hold as support. Short trade. Once the support level has broken, wait until the support has held as resistance. Conclusion.
At the support level, there are adequate buyers to stop the price from falling further and reverse the cost to the upside. At the resistance level, there are adequate sellers to stop the price from rising further and reverse the cost to the downside. Place horizontal lines on a chart where the price seems to stop repeatedly to find the support and resistance levels. When our approach is stable, we can use the wicks or the bodies of the candlesticks to draw support and resistance.
Support can become resistance, and resistance can become support.
We need to be careful to avoid false breakouts. The price may pretend to break through support or resistance but will reverse in the opposite direction.
Frequently asked questions. How is resistance identified on a price chart?
Resistance is identified on a price chart by observing points where the price has repeatedly faced selling pressure and struggled to move higher. These points are marked as resistance levels.
How can traders use resistance levels in their strategies?
Traders use resistance levels to set profit targets, place stop-loss orders, and make decisions on entering or exiting positions.
Breakouts above resistance levels can trigger buying opportunities. What factors contribute to the creation of resistance levels? Resistance levels are created by an influx of selling orders, profit taking by traders, or a general consensus that the current price is too high. How does volume relate to resistance analysis? High trading volume around a resistance level often strengthens its significance. Increased volume during a failed attempt to break resistance or a successful breakout adds credibility to the analysis. Can resistance analysis be applied to different time frames?
Yes, resistance analysis can be applied to various timeframes, such as daily, weekly, or monthly charts, depending on the trader's preferences and the nature of the market.
How does news and external events impact resistance levels?
News and external events can influence resistance levels, especially if they trigger a significant change in market sentiment.
Positive news may lead to attempts to break resistance, while negative news may reinforce resistance. Identifying support and resistance levels.
To pinpoint support and resistance levels, one examines areas on the price chart where the market consistently halts or changes direction. These are zones where buyers or sellers actively participate in the market.
Practice session. Exercise 1.
The depicted chart illustrates instances where the price consistently increases and reaches the same level repeatedly. By drawing a horizontal line at the points where the price appears to halt, it becomes possible to identify a resistance level, indicative of sellers entering the market and causing the price to stall.
Resistance levels. Exercise 2.
In the chart below, there's an instance where the price descends to a specific level, experiences repeated halts, and subsequently reverses its direction upward. To identify a support level, a horizontal line is drawn at this particular price level. This assists in recognizing a zone where buyers enter the market consistently, prevailing over the sellers, and causing a reversal in the price movement.
Resistance levels. Support and resistance in a range. In a sideways market, the price repeatedly touches the same support and resistance levels before finally breaking out of the trading range. Resistance levels. Price finds resistance in a range. Price finds support in a range.
The price ultimately breaks out of the range with the support. As evident from the chart above, the resistance level acts as a distinct upper limit, while the support level serves as a clear lower boundary for the range.
A breakout occurs when sellers prevail over buyers, penetrating the established support level.
Establishing support and resistance levels based on candle wicks and bodies. The next two charts illustrate instances of setting support or resistance lines by considering both the wicks and bodies of the candles. The chart below demonstrates an example of using the wicks of the candles to position a resistance line.
Resistance levels.
The chart below illustrates an example of employing the bodies of the candles to establish a resistance line. There is no universally correct method for placing support and resistance, rather, it depends on the trader's preference or the strategy being employed.
Resistance levels. Support and resistance zones.
Support and resistance levels are not always easily determined with a single line, hence, it is often more effective to define a zone. In the chart below, you can observe that the price faces resistance multiple times at various levels, highlighting the importance of considering a broader support and resistance zone.
Resistance levels.
There isn't a specific price level where sellers consistently enter the market, rather, sellers dominate buyers at various price levels.
Nevertheless, what is evident is the existence of a resistance zone, indicating the range of prices at which sellers are actively entering the market. Resistance can become support.
Price breaches a support or resistance level when one side prevails over the other.
Following breakthrough support or resistance, it's not uncommon for the price to revisit the breakout level before resuming its movement.
In such instances, the former support may act as resistance, or the previous resistance may turn into support. In the example from the chart below, the price successfully broke through a resistance level, signifying the buyer's dominance over the sellers at that particular price point.
Resistance levels. Price encounters resistance. Price breaches the resistance.
The price retraces to the former resistance level, now functioning as support. Those who sold when the price hit the resistance level would be losing money as the price kept going up. When the price returns to the old resistance level, traders who bet on the price going down will give up and buy, adding more buying power. New traders who haven't joined the market yet might also start buying at this price, expecting the price to go up. This additional buying pressure causes the price to keep rising. The old resistance level now acts like a support level, holding the price from falling back down. Note, closing a position: to end a long position, you sell your asset to the market. To end a short position, you purchase the asset. Support can become resistance. Likewise, if the price surpasses a support level and later returns to that level, sellers may enter the market, causing the price to decline further. The chart below provides additional instances of support transforming into resistance and resistance transforming into support. In this example, the same price level serves as both support and resistance on multiple occasions. Resistance levels. Price discovers support. Price breaches the support. The price retraces to the prior support, now acting as resistance. Price surpasses the resistance and subsequently finds support again. Nutshell. Resistance level: sellers at this level prevent the price from rising, causing a reversal to the downside. Identify support and resistance: use horizontal lines on the chart where the price frequently halts to determine support and resistance levels. Drawing lines: use candlestick wicks or bodies to draw support and resistance lines when the approach is stable. Interchangeable roles: support can turn into resistance, and resistance can transform into support. Beware of false breakouts: exercise caution to avoid being misled by false breakout signals. Reversals: the price might feign breaking through support or resistance but ultimately reverse in the opposite direction. Frequently asked questions. How do I identify support and resistance levels on a price chart? To pinpoint support and resistance, examine areas where the market consistently halts or changes direction. These are zones where buyers or sellers actively participate. Can you explain the concept of support and resistance in a sideways market? In a sideways market, prices repeatedly touch the same support and resistance levels before breaking out. Support acts as a lower boundary, and resistance acts as an upper limit. How do I establish support and resistance using candle wicks and bodies? Consider both the wicks and bodies of candles to set support or resistance lines. There's no universal method, it depends on trader preference or strategy. What is the significance of support and resistance zones? Support and resistance levels aren't always determined by a single line. Defining a zone is often more effective, considering the price faces resistance at various levels. Can you explain why support can become resistance and vice versa? When a price breaks through a support or resistance level, it may come back to that level before continuing. In such cases, the former support may act as resistance, and vice versa, based on market dynamics. Sell on resistance area. Resistance levels serve as potential entry points for initiating new short positions. In the provided chart, a distinct resistance level is identified, indicating a likelihood of price decline upon reaching this level. A strategic approach involves entering a new short position at this specific price with a recommended stop loss set beyond the identified resistance level. Resistance area. Number 1, resistance level. Number 2, price encounters resistance at this level. Number 3, initiate a short entry after the price level effectively holds as resistance. Number 4, place the stop loss above the resistance level. False breakouts. The chart below illustrates a situation where the price seemed to breach a resistance level but failed to sustain above it, commonly referred to as a false breakout. Resistance area. Price encounters resistance. Price broke through the resistance level but failed to sustain above it. If a trader aims to initiate a long position after a resistance level break, it's prudent to wait until the established resistance turns into support to avoid falling for a false breakout. Likewise, for entering short trades after a support level breach, it's wise to wait until the support transforms into resistance to steer clear of false breakouts. Considerations when using support and resistance. Support and resistance levels are subjective, varying among traders. Identification of key support and resistance levels improves with experience, preventing the tendency to identify too many potential reversal points in the price. Nutshell. Support is a price level where sufficient buyers halt further price declines and cause an upward reversal. Resistance is a price level where ample sellers prevent further price increases and lead to a downward reversal. Support and resistance levels are identifiable by placing horizontal lines on a chart where the price consistently stops. Use either the wicks or bodies of candlesticks to draw support and resistance, maintaining consistency in your approach.
Support can transform into resistance, and vice versa.
Exercise caution with false breakouts, where the price appears to breach support or resistance but reverses in the opposite direction.
Frequently asked questions. How can one purchase at support and sell at resistance?
The strategy involves buying when prices are at support levels and selling when prices are at resistance levels. Note that these levels are zones, not exact points.
How do you trade at support?
The basic strategy is to buy at the support level and sell at the resistance level, recognizing that these are zones of potential demand and supply changes.
How does resistance work?
Resistance in the share market indicates how easily current flows in a circuit, measured in ohms, O. Current increases with decreased resistance and decreases with increased resistance, which is crucial for maintaining proper current flow.
What is the professional support and resistance trading strategy?
These indicators identify predetermined levels where market prices are expected to stop and reverse. This technical analysis helps analyze price charts and determine market direction and entry points.
How do you calculate resistance levels? Use pivot points, PP.
The formula for calculating the first resistance level, R1, is 2 times the pivot point minus the low.
Second resistance, R2, equals PP plus, high, low. Third resistance, R3, equals high plus 2, PP low. Support become resistance. When support becomes resistance.
A fascinating aspect of support and resistance is observed when the underlying asset's price successfully breaks through an identified level.
It's not unusual for a former support or resistance level to undergo a transformation. Support becomes resistance.
In the chart depicted above, the dotted line initially represents the support level at S. However, once the price falls below this level, as shown as R, the one supportive line often transitions into a new, short-term resistance area.
Why does support become resistance?
Support becoming resistance is a common occurrence in the stock market due to shifts in investor sentiment. When a price level that previously acted as a support, or buying interest was observed, is breached, it can flip roles and become a resistance level. This happens because investors who bought at the support level and expected the price to rise may now become sellers, trying to break even as the price approaches their original entry point. The psychological shift from viewing a level as a support to now seeing it as a potential resistance reflects changing perceptions and market dynamics.
Practice session. Identify accurately drawn support levels. Demonstrate the concept of support and resistance within a range. In a market characterized by consolidation, the price repeatedly encounters the same support and resistance levels before eventually breaking out of the range. Support becomes resistance. 1. Support level. 2. Prices breaks through support level. 3. Support turns into resistance points. The above illustration depicts a distinct upper limit provided by the resistance level and a well-defined lower limit by the support level within the range. A breakout ensues when sellers exert dominance, breaching the established support level. Example.
In the below chart, when the support level is broken, sellers enter the market, causing the price to persistently decline upon returning to this level. The illustration below illustrates the transformation of support into resistance. The specific price level in this depiction functions as both support and resistance on multiple occasions. Support becomes resistance. In the above chart, when the price has been decreasing to break the support level, now the support line breakout happens and changes the support line into a new resistance line. At the price 1688.1 for the price breaks the support level marked as support range breakout, and thus the support becomes resistance.
Summary. Support levels feature sufficient buyers to prevent further price decline and initiate an upward reversal. Resistance levels involve ample sellers to hinder further price ascent and prompt a downward reversal.
Identify support and resistance levels by placing horizontal lines on the chart where the price frequently halts. When employing a reliable approach, use candlestick wicks or bodies to establish support and resistance.
Note that support can transform into resistance, and vice versa.
Exercise caution to avoid false breakouts where the price feigns breaking through support or resistance but subsequently reverses direction.
Frequently asked questions. When resistance becomes support?
When resistance becomes support, it signifies a notable shift in market dynamics.
Former resistance levels, once surpassed, transform into new support levels.
This reversal indicates a positive change in investor sentiment, as the price, which previously faced selling pressure, is now viewed as a level where buyers are likely to step in.
This phenomenon is often interpreted as a bullish signal, suggesting potential upward momentum in the security's price. Traders closely monitor these transitions as they provide insights into evolving market trends and opportunities for strategic entry points. What is support resistance in stock market?
Support and resistance are key concepts in the stock market, representing levels where the price tends to stop or reverse its direction. Support is a level where buying interest is significant, preventing the price from falling further.
Resistance is a level where selling interest is notable, impeding the price from rising further. How to draw support and resistance for intraday. For intraday, identify key price levels and pivot points. Focus on round numbers and psychological levels. Draw trend lines connecting highs and lows.
Watch volume profiles for significant trading activity.
Use dynamic indicators like moving averages. Stay adaptable, adjusting levels based on real-time price action.
Visit Enrich Money to stay updated with real-time price levels.
How to find support and resistance levels in Bank Nifty. Find Bank Nifty support and resistance. Use prior highs and lows. Calculate pivot points. Consider round numbers. Draw trend lines for trend analysis. Analyze volume profiles. Utilize moving averages. Apply Fibonacci retracements. Note price gaps. Review option chain data. Monitor intraday price action for adjustments. Access comprehensive research on Bank Nifty through Enrich Money. How to trade support and resistance breakout.
Trade support/resistance breakout.
Identify key levels. Wait for a confirmed breakout.
Confirm with increased volume. Set stop loss for risk management.
Establish profit targets. Use indicators for confirmation. Trade in line with the trend.
Monitor price action for reversals.
Stay informed about relevant news from Enrich Money. Review and learn from each trade. Buy on support area.
Buying a stock or security at support is a tried and tested trading strategy where investors or traders initiate a buy position when the price of a financial asset approaches or reaches a historically established support level.
Here's a detailed explanation of this strategy.
Executing purchases at a support level involves recognizing moments when buyers or bullish traders are considered to be in control at a particular price level following a minor retracement into a well-defined support area. Strategy to buy stock at support.
Identifying support area.
A support area is a price level where an asset has historically shown resilience against falling further. Traders identify these areas by analyzing price charts, looking for instances where the price has bounced back or consolidated in the past.
Technical analysis tools.
Traders use various technical analysis tools such as trendlines, horizontal support zones, moving averages, or Fibonacci retracement levels to pinpoint potential support areas. These tools help in visually identifying levels where buying interest has historically emerged.
Confirmation of support.
Before initiating a buy order, traders seek confirmation that the price is respecting the identified support level. This confirmation may involve observing price reactions, looking for candlestick patterns, like doji or hammer, or using additional technical indicators for validation.
Risk management.
Effective risk management is crucial. Setting a stop-loss order just below the identified support level helps mitigate potential losses if the price breaks below the expected support.
This defines the acceptable risk for the trade. Execution.
Once the support level is confirmed and risk management is in place, the trader executes a buy order with the expectation that the price will rebound from the support, creating a favorable trading opportunity.
Monitoring and adjusting.
Traders continuously monitor the trade, adjusting their strategy based on how the price behaves around the support area. If the price starts to break below the support, it might trigger the stop loss, limiting potential losses. Practice session. Finding the support place. Engaging in trading based on support or resistance involves utilizing support levels to initiate long positions. As depicted below, a support level is evident, indicating a potential area where the price might rebound. Taking advantage of these support levels, traders may consider entering new long positions, with stop-loss orders positioned just beneath the established support level.
Buy on support area. 1. Support level identified. 2. Price establishes support at this level. 3. Long buy entry order can be placed once price confirms support.
4. Stop-loss positioned below the support level.
Inference.
At the support level in stock market, there exists a sufficient number of buyers to prevent further price declines and initiate an upward reversal. Similarly, at the resistance in stock market, there are ample sellers to impede further price increases and trigger a downward reversal. To identify these levels, a horizontal line is marked on the chart where the price has consistently halted its movement. Once this methodology is established, either the candlestick wicks or bodies to delineate support and resistance levels can be utilized. It's important to note that share market support and resistance can transition into each other, and vice versa. Caution is warranted to avoid false breakouts, where the price appears to breach support or resistance temporarily but ultimately reverses course in the opposite direction.
Conclusion.
Buying on a support area is a part of technical analysis and requires a comprehensive understanding of market conditions, trend analysis, and potential catalysts that may impact the asset's price movement. This strategy aims to capitalize on the potential for a price bounce at established support levels.
Frequently asked questions. What does buying on support mean?
Buying on support refers to the strategy of purchasing a financial asset when its price reaches a level of support, which is typically a historical low or a significant price level where buyers are expected to enter the market.
How do I identify support levels?
Support levels can be identified by analyzing historical price data and looking for areas where the price has previously bounced back after declining. These levels often coincide with previous lows, trend lines, moving averages, or psychological price levels.
When is the best time to buy on support?
The best time to buy on support is when the price reaches the support level and shows signs of bouncing back, such as bullish candlestick patterns, increased buying volume, or a shift in momentum indicators.
Where should I place my stop loss when buying on support? Stop loss orders are typically placed slightly below the support level to account for potential false breakouts or extended declines. This helps limit potential losses if the trade goes against you. Can support levels become resistance levels, and vice versa?
Yes, support levels can become resistance levels if the price breaks below the support and then retests it from below. Similarly, resistance levels can become support levels if the price breaks above the resistance and then retests it from above.
Significance of support and resistance in trading. How to identify support and resistance levels? Support and resistance are fundamental elements in trading, serving as the building blocks for predicting price movements and future trends. These levels offer valuable information about market behavior, empowering traders to make more informed decisions. The significance of recognizing support and resistance levels. Analyzing support and resistance levels becomes an integral aspect of discerning price trends in stock markets. This analysis not only aids investors in making profitable trading decisions but also plays a role in anticipating potential trend reversals. Risk management.
Identifying support and resistance levels proves instrumental in effective risk management. Traders commonly place stop-loss and take-profit orders near these levels to define risk and reward. Knowing when to exit a trade if it deviates from the plan and determining where to take profits are crucial aspects of managing risk and maintaining trading discipline.
Trade entries and exits. Support and resistance lines act as valuable guides for determining entry and exit points.
Traders may opt to enter a long trade near a support level or initiate a short position near a resistance level, anticipating potential price reversals or breakouts.
Trend identification. Understanding support and resistance levels aids in trend identification.
An upward trend is often confirmed when an asset's price consistently bounces off support levels, while a downward trend may be established when resistance levels are regularly tested and held.
Understanding these trends is essential for making well-informed trading choices. Volatility indicators. Breaching support or resistance levels signals a potential change in market sentiment and increased volatility. Breakouts from these levels present trading opportunities, as they often lead to significant price movements. Psychological significance. Support and resistance lines carry psychological weight in traders' minds. Approaching a significant support level may be perceived as a buying opportunity, while at resistance levels, traders may see it as an ideal point to sell. This collective psychology can lead to self-fulfilling prophecies, impacting price movements based on traders' actions around these levels. Incorporating these insights into trading practices enhances the ability to navigate market dynamics effectively, leveraging the valuable information provided by support and resistance levels. Drawbacks of support and resistance in trading. Subjectivity and interpretation. The utilization of support and resistance levels in trading is hindered by subjectivity and open interpretation. Traders often hold differing opinions on the placement of these levels, introducing inconsistency in their analyses. Non-foolproof nature. Support and resistance levels lack foolproof reliability as indicators. Grounded in historical price data, they assume the market will follow analogous patterns in the future. However, shifts in market dynamics can render these levels ineffective. Self-fulfilling prophecies. Support and resistance levels may act as self-fulfilling prophecies. Many traders reacting to these levels can lead to crowded trades, potentially resulting in price manipulation. Ineffectiveness in volatility. Support and resistance levels may prove ineffective in choppy or highly volatile markets. Unpredictable and frequent price swings in such markets can challenge the reliability of these levels. Necessity for supplementary indicators. Traders are advised to use additional indicators and analysis methods alongside support and resistance levels. This complementary approach is crucial for making more informed trading decisions, particularly in dynamic market conditions. Trading tips. Emphasizing the importance of both support and resistance points is crucial in share trading. Avoid making investments when the price is within the range of these 2 points, considering the surrounding area is highly unpredictable. This cautious approach aligns with the understanding that the region around support and resistance levels can exhibit significant volatility. Bullish investors are advised to refrain from placing stock orders directly at the support level. Conversely, it is beneficial to place an order slightly above the support level, in close proximity to it. For investors considering stops or short selling, setting up a trade price at or below the support level is a prudent strategy. Frequently asked questions. How to identify support and resistance zones? Examine the chart for a significant pause in price decline or rise, and observe if the price halts or reverses as it approaches that level. This helps recognize key support and resistance levels for effective trading analysis. Any specific tips for trading around support and resistance? Emphasizing the importance of both support and resistance is crucial. Investors are advised to avoid investments within this range, given its unpredictability. Tailored strategies, like placing orders slightly above support levels for bullish investors, can enhance trading outcomes. How can support and resistance levels be practically applied in trading? Identifying these levels is instrumental in effective risk management, guiding traders in placing stop-loss and take-profit orders. Additionally, support and resistance lines serve as valuable guides for determining entry and exit points, and enhancing trading decisions. How does identifying support and resistance levels impact trading decisions? Analyzing support and resistance becomes integral for discerning price trends, aiding in making profitable trading decisions, and anticipating potential trend reversals. How to identify support and resistance zones? To determine support and resistance levels, start with the pivot point. For instance, calculate support 1 S1 using the formula 2 *PP high and resistance 1 R1 is 2 *PP low. Utilizing online calculators or trading platforms can automate the computation of pivot points based on input data, simplifying the process.